name's Waffles, and I'm a government whistleblower turned political commentator, and here are the top economic news highlights for the past 24 hours. Today is December 7th, 2025. It is 4:43 p.m. at Mountain Standard Time. Today, the Dow Jones closed up 0.22%, the S&P up 0.19%, and the NASDAQ up 0.31%. Market fixed on Fed rate cut, focus shifts to future projections. Monetary policy investor and analyst attention is fully fixed on the upcoming Federal Open Market Committee FOMC meeting expected to conclude on Wednesday. Near-term certainty, markets are pricing in an almost certain 25 basis point interest rate cut, the third straight, to a range of 3.5 to 3.75. The key focus is now the FOMC's updated economic projections and the dot plot, which will indicate the likely path to future rate cuts in 2026. This forward guidance will drive market action for the rest of the year. Market finishes week positive, driven by tech and consumer names. Today is Sunday. The market didn't close. That was Friday's closing numbers. Jesus Christ, dude. I don't even know what fucking day it is anymore. U.S. equity markets finished the week on Friday, December 5th, with modest gains across the major indices, S&P, Dow, and NASDAQ. The positive momentum was attributed to cooling inflation data, PCE report, and sustained investor confidence in technology, AI, and cloud infrastructure, and consumer and financial sectors, suggesting a broadly positive, albeit cautious outlook heading into the new year. Economic data and regulatory changes, real consumer spending confirmed to have flatlined. Weekend analysis of recent personal income and outlays report confirmed that real personal consumption expenditures, real PCE, spending adjusted for inflation, saw effectively 0.0% growth in September. This finding corroborates the Atlanta Fed's downward revision of its Q3 GDP forecast, indicating that the moderate increase in nominal consumer spending was entirely offset by persistent price increases. Inflation essentially made it so that the very small growth in consumer spending was snuffed out by inflation caused by the tariffs. This suggests the consumer is cautious and not contributing substantially to real economic growth. FinCEN delays key real estate money laundering rule. The Financial Crimes Enforcement Network, FinCEN, issued an exemptive relief order to postpone the start of the reporting requirements under its new residential real estate rule until March 1st, 2026. While the rule will require mandatory reporting on all cash transfers of residential property to legal entities and trusts, it is officially effective this 3-month grace period. The real estate industry gives the real estate industry time to develop compliance systems, effectively slowing the immediate impact of the new anti-money laundering measure. Based on what I've been seeing this administration do and the amount of financial crimes it appears that this administration is likely involved in, I'm just assuming that the delay is to encourage money laundering. Mortgage rates continue to drift lower. Consumer and Infrastructure Watch reports indicated that mortgage rates are continuing to fall, hitting a new 14-month low ahead of the expected Fed rate cut. The lower borrowing costs are expected to provide a slight boost to mortgage applications and may help thaw activity in the housing market, which has been in a sustained slump due to high rates and low inventory. Mortgage rates hit new 14-month low, driving affordability up. The 30-year fixed mortgage rate average in the U.S. has fallen to 6.19% as of December 4th, widely reported over the weekend, down from 6.93% at the start of the year. This drop driven by cooling inflation, and I don't see inflation fucking cooling. Where does that information coming from? And the anticipated Fed rate cuts have pushed housing affordability to a 3-year best. Analysts predict this slight rate moderation will encourage more buyers to re-enter the market and forecast a 4.3% rise in existing home sales in 2026. Everybody's broke right now and consumers are not spending, so those houses are probably going to be bought up by super rich people and corporations, just furthering the wealth divide and fucking over Americans. Welcome to the podcast where I have nothing nice to say about anything that this administration has been doing. Trade policy and governance. Retail giant Costco has emerged as the only major U.S. retailer to openly and formally challenge the administration on tariff refunds, specifically on goods imported during the government shutdown. Buffered by its strong customer loyalty, Costco's move highlights a growing pressure point between major U.S. importers and the administration's aggressive trade policies. The challenge is linked to the broader legal battle over the president's authority to impose tariffs under the International Emergency Economic Powers Act, IEEPA. They're trying to get their money back that Trump essentially stole off of them, using the tariffs as a tool to defraud the planet. DOE moves to streamline energy permitting and infrastructure. Policy shifts in infrastructure. Watch. The Department of Energy, DOE, released key studies from the National Petroleum Council, NPC, over the weekend, offering comprehensive recommendations to modernize energy infrastructure and streamline federal permitting. When they are talking about modernization, they are talking about nuclear and gas. The recommendations advocate for legislative and executive action to clarify the scope of the National Environmental Policy Act and EPA, expedite legal reviews for environmental cases, and accelerate approval timelines for natural gas and other critical energy projects. This aligns with the administration's energy dominance agenda aimed at reducing regulatory roadblocks. Sustainable energy is green energy. If something's sustainable, it means it can last a long time. Gas cannot last a long time. Solar panels just sit there and collect energy. This is not effective, and it is going to put us behind other nations in global affairs. It essentially just has us spending money on gas products that we would likely not otherwise be spending if we're going to base our energy infrastructure off of gas and nuclear. Expenditures are going to go into non-renewable resources when we could just have solar panels fucking sitting there getting fucking energy. Wasted money. Federal Reserve requests input on check services modernization. The Federal Reserve Board requested public input regarding potential strategic changes to the check services it provides. The move signals the Fed's intent to modernize and potentially consolidate the legacy systems used for check clearing. While most payment processing has shifted to digital methods, the Fed is assessing how to adapt this service, which remains vital for many small businesses and community banks. Annual home price growth decelerates to lowest rate since 2012. Consumer Watch new data confirms that year-over-year U.S. home price growth continued its downward trend, rising only 1.1% in October, the lowest rate since early 2012. Price declines have expanded to 32 of the 100 largest metros, marking the broadest softening since the early 2010s. This deceleration is viewed by economists as a much-needed rebalancing after years of unsustainable gains, and is expected to help restore affordability over time. Yeah, well, that sounds great. The American consumer is literally getting bled dry right now. So it's not the American consumer that's going to be buying any homes. And there seems to be a lot of indicators that what's going on with the housing market is that we're just going to price everybody out of being able to live and make it so nobody's able to afford a house. And then the people with all the money, the corporations, are going to come and buy the fucking houses, and fuck you. Why the hell is there commercials on my YouTube telling me how to kick someone out of their house because they defaulted on their debt? So while it's great to say that housing prices are dropping, it doesn't mean that people are going to be able to afford those houses. And there's a lot of very clear signs that there are criminal enterprises seeking to essentially defraud the housing market, which is probably a big part of Donald Trump's plans with this Project 2025 shit and all the shit that he's been doing that's reckless towards the economy, because he's a real estate guy, right? Overall household debt hit a new record. This is exactly what I'm talking about. People can't afford shit. So who's buying houses when house prices crash, which are being deliberately forced to crash, in my opinion? Overall household debt hit a new record, $18.59 trillion in Q3 2025. Borrowing rose by about $197 billion over the prior quarter. Mortgage balances increased by $137 billion. Credit card balances rose by $24 billion. Student loan and home equity line balances also climbed. Credit card debt remains elevated, but delinquency looks more stable than expected. Outstanding credit card debt is now about $1.23 trillion. According to recent data, credit card delinquencies now 2.9%, have eased slightly compared with a year ago. Consumers increased borrowing, but more non-mortgage credit as well, signaling reliance on debt. Recent Federal Reserve data show non-mortgage credit, auto loans, personal lines, ECT grew, continuing a trend of households leaning on credit as cost pressures mount from Donald Trump's inflation caused by the tariffs, caused by Donald Trump trying to defraud half of the fucking planet. Consumer spending remains lukewarm even as inflation pressures linger. The latest consumption data showed consumer spending rose modestly but not strongly, and the core inflation measure PCE increased by 0.3%, keeping inflation at roughly 2.8% year over year. That leaves households squeezed between elevated prices and rising debt. Labor market signals remain mixed. Jobless claims fell sharply, but private sector payrolls show weakness. Unemployment benefit filings dropped by 27,000 to 191,000 last week, the lowest since 2022. However, separate data show U.S. private employers cut 32,000 jobs in November, underscoring uneven labor market conditions. Markets respond to tightening economic signals with growing bets on interest rate cuts by the Federal Reserve. With weak spending, rising debt, and signs of labor market softening, investors are increasingly pricing in a rate cut at the Fed's December meeting, driving stock gains and a weaker dollar. Why these things matter: debt burden and leverage risk across households, with total household debt elevated and consumer borrowing growing. Both revolving and non-revolving, many households may be vulnerable to interest rate sensitivity, job losses, and cost of living shocks. Potential stress among lower and middle income families. While credit card delinquency rates have not spiked yet, high debt loans plus modest spending and inflation suggest financial fragility for many, especially given student loan delinquency and auto loan pressures. Something to keep an eye on what's going on with delinquency after they do this stupid ass rate cut. Uneven labor market, risk of two-speed economy. The drop in jobless claims may mask underlying weakness, payroll losses, hiring freezes, fewer quality job openings, creating unstable employment, which could reduce consumer demand and strain debt servicing. Interest rate and monetary policy uncertainty as markets price in potential rate cuts. Debt-carrying households may get relief, but volatility remains high. If inflation persists or external shocks arrive, rates could remain elevated, worsening costs for borrowers and destabilizing credit markets. Fragile consumer spending and retail demand base. Weak spending growth so far may translate into sluggish retail, real estate, and service sector performance, a drag on broader economic growth as borrowing becomes more central to consumption. Consumer sentiment ticked up in December, a small tentative improvement. According to a widely tracked survey, the monthly consumer sentiment index rose to 53.3 in December from 51.0 in November. Household net worth rose strongly in quarter two, though debt growth remains substantial. According to the latest release of the Federal Reserve's financial accounts, Z1 household net worth climbed by $7.1 trillion in quarter two, 2025, but household debt also grew at a 3.8% annualized pace, driven by mortgage and consumer credit expansion. Small businesses reportedly slashed a large number of jobs, signaling stress among smaller employers. A recent sector-level report claims small businesses under 50 employees eliminated 120,000 jobs, while mid-size and large firms added staff. This skew in job cuts may signal fragile demand or financial stress among smaller employers. Yeah, people are trying to monopolize the markets. Donald Trump is colluding with people to do harm to the United States economy and is deliberately trying to put small business out of business. The schedule for key economic and trade data releases remains disrupted post-shutdown. The Bureau of Economic Analysis, BEA, issued an update. The next International Trade in Goods and Services report for September 2025 was rescheduled to December 11th, indicating a data flow uncertainty may persist, a complicating factor for micro-forecasting. Debt service and non-mortgage borrowing continue to rise, risk undercurrents building under surface borrowing growth. The Z1 data also showed non-mortgage consumer credit, auto, personal lines, ECT and business credit continue to expand, suggesting some households and firms remain dependent on credit growth even as economic headwinds remain. Affordability crisis narrative increasingly reinforced by independent analysis, costs up, wage growth lagging, may shape politics and consumer behavior. A recent analysis published today argues that despite certain economic strengths, inflation, rising borrowing costs, and weak wage growth continue to erode affordability for many Americans, especially in housing, essentials, and debt-laden households. This is according to the source for this is ft.com. The article is titled "America's Affordability Crunch is Real and Worse Under Trump." That's the Financial Times. Global investor flows toward U.S. remains strong. International confidence in U.S. investment climate appears resilient. According to a European CEO survey released today, a substantial portion of major European firms plan to increase investment in the U.S., citing U.S. market opportunities and relative policy stability, a sign that despite domestic stress, global capital still sees the U.S. as a safe haven. I don't understand why the motherfucker's threatening everybody. He's trying to steal money from half the planet with his tariffs and shit. Why the fuck would you think this is a place to invest in? Alright, well, that would be it to conclude today's economic reporting. So I'm going to go now. Bye.
So the Olympics is great. And Johnny, for the others, you know, the World Cup, Johnny is the head of it. We had our top people, Wasserman. They all came in on the Olympics, and then I saw Johnny. And we got the World Cup, too. And, you know, it's only because they rigged the election that I'll be your president representing you there. You know, I got both of them. I got the Olympics, and I got the World Cup. And I said, you know, it's too bad. One was in 2026, and the other was in 2028. And I said, I won't be there. I won't be your president. But then they rigged the election, and now we won. So I'm going to be your president for the Olympics and for the World Cup. So, Johnny, thank you for the World Cup. And everybody, thank you for the Olympics. We're going to have a great time.
Hey, guys, don't forget to like, share, subscribe, and comment to my videos. And also, don't forget to check out my shop where you could get this awesome Real Patriots Punch Nazis t-shirt. America, fuck yeah! And if you go to the link tree in my bio on most platforms, it's got links to everything, all of my stuff. You can find my shop there. I'm on eBay. You can also get this cool Exterminate MAGA sticker, because MAGA's fucking cockroaches. And fuck MAGA. Abolish MAGA. Fuck you, MAGA.